for today. Today we have with us Viraj Khatavkar. He's a software engineer by profession. So he got introduced to the markets during the bull run in 2017. As we, most of us, in our initial investing journey, makes lots of mistakes. Likewise, Viraj also had his side of mistakes, and gradually he moved to momentum investing. And he also like to do a lot of back test on different trading strategies, including options. And he also runs a newsletter that goes by the name of momoindia.substack.cim, and also a momentum screener website. And the name for the website is momoindiascreener.in. So, Viraj, a very warm welcome. And just in case I missed out anything on your introduction, would appreciate to begin with, like how it all started for you and how it graduated over a period of time.
Yeah, sure. I mean, you covered most of my introduction there. Thank you for that, Prince. And firstly, I would like to thank you to actually invite me for such a session. Really looking forward to it. Uh, so, to introduce myself, actually, as you rightly said, I got introduced to markets in the bull run of 2017. I would like to say mostly on the fag end of the bull run of 2017 when I saw all the stocks going up and the usual stuff that happens. So, I basically opened my Demat account first time in around, I think, September or October 2017. And I still remember the first stock that I bought was Make Money Organics. There was a little bit of hype there. I had listened to a couple of con calls and the usual stuff, and I basically put a decent bit of money in Make Money. It was not like one or two shares, but I put around 5 to 8 lakhs in Make Money Organics in my first investment, and I like usually I started reading Warren Buffett. I started listening to his videos and all that stuff, and basically concentrated investing was something that I got fascinated with, and I thought I will only ever own like 3 to 5 stocks, and I want to make a lot of money with that and get rich basically. I still remember like in during that period I invested in 3 stocks after that total. So Make Money was my first one, second one was Moorpin Labs, and third one was Ashok Leyland. um, Both, all three of them fell down after January 2018. The budget that came in and introduced 10% LTCG and a couple of other things, like 2018 was a brutal year for small caps and mid caps, and all three of those stocks gave me decent amount of losses, around I think 15-20% at least, if not more. I don't remember the exact number, but that's how it was. And at that point of time, I started to understand, okay, like this is not working out for me. Ki baba, I cannot just like read companies annual reports and say that okay, I like this company, they have good management or stuff like that. So it was very difficult for me to gauge anything on that part. I wanted something quantifiable, like ki I want to buy something and then I want to know how to sell it. The usual advice at that point of time was like sell when the company's management has stopped performing and stuff like that, but it was all discretionary to me, and I wasn't really sure whether I can implement it and all that stuff. So it was like a lot of confusing period. I went through a lot of strategies like quality strategy. Then I didn't came across momentum at that point of time, but like a ton of other discretionary strategies like invest in only in quality stocks, which became famous in 2018 because they survived very well in that bear market. So like, or just buy good quality stocks irrespective of what their P was and all that stuff. So that's how I got started. Like researching about different ways to invest, and eventually at the end of 2018 I was attending this carnival, investors carnival or something. It was in Goa, and that's where I first got to know about momentum investing. There was a session by Alok Jain. I think everybody knows Alok Jain, and he was doing a session on momentum investing. And when I heard about that session, it was like a light bulb going off in my head. I know it's very uh, cliche, but that's what actually happened. Like I was like, "Fuck!" Sorry, I was like, "Yeah, this is something uh, that suits me." I wasn't sure if I'm gonna put all my equity behind it, but I was really sure like I want to know more about it and stuff like that, and that's how I got to uh, introduce with respect to momentum investing and stuff. I met a ton of other investors as well in that carnival. I think I met a couple of people from Capital Mind. There was, I think, Vashishta was there, and I think I met Deepak Shina as well. I met Utsav and a lot of other people from where I got a lot of knowledge as well. And yeah, that's how I basically got to introduce to momentum investing.
Interesting. So Viraj, would appreciate like if you simplify what momentum is investing is all about and what all types of momentum investing is. So that would be really helpful for all of us.
Yeah, sure. I mean, traditionally, if you go by very theoretical so momentum is a factor. There are multiple factors. Momentum is one of those factors. There is a quality factor. There is low volatility, which is another type of factor in investing. So momentum, as we say, is one of the factors. And so traditionally, with factor definition, momentum can be defined as whatever is going up, we should be buying. So whatever is going up, it means whatever is going up in terms of price. So for example, if some stock is going up, it was 100 3 months ago, and today it is 150, then it means that the stock's price is going up. So in that sense, we should be buying that. But it also, in a traditional factor definition, it also tells us to short stocks which are going down. So, for example, if some stock was at 100 and it goes down to 70, then we should also short that stock. And that is what we call as long short momentum, something like that, in traditional factor definition. So the first time the paper, like a very theoretical paper with proper back tests and like not just saying like it works, but backing it with proper data, was done by Jagdish Titaman. It was I don't remember the exact year, but it was sometime in 93 or 94 in the 90s. That's where they defined momentum, and this was like long short momentum. Like suppose you have 1,000 stock index. So what you will do is you will say take top decile of stocks. So top decile is basically say 10% of the total universe. So the top decile comes out to be 10% of the stock. So that amounts to 100 stocks. So what you will do is every month you will take this top decile of the stocks and go long on that stocks, those 100 stocks, and then you also take the bottom decile of the stocks, which is from 901 to 1,000 rank, and you will go short on those stocks. And you do this every month, and you test out like what is the returns of that returns of this strategy. And they found out that this strategy did work, like it. So when we say strategy work, it means it beat the market returns, right? So there was some alpha in this strategy, and it was not like a 2 or 3 or a 5 year backtest. It was across periods, across regimes of the market. And that's what traditionally momentum was defined as a long short momentum. But it's actually very difficult to practice this kind of momentum in classical Indian markets, or even in US for that matter. So going short on a stock is very difficult for us. We have to either do it by futures. In India too, we cannot even do it directly. It's very tough. I mean, we can technically do it, but it's very tough to do that. In US, it's pretty much easy, but in India, doing short leg of the momentum is very difficult. So eventually, other papers came out which started testing out only price momentum. So again, price momentum, as in we take the price of the stock and see which stocks went up, and we go long on them. And we repeat this either every week or every month and keep on doing this strategy. So that's how we define a typical momentum system. Now, this is just a broad overview. I would. So, do you want me to go a little bit into technicalities of it right now, or a little bit later?
Yeah, yeah, yeah. You can continue.
Okay. So, we'll just discuss one research that was being done by Wes Gray. So they run a very good website known as Alpha Architect, and they also have a book by the name of Quantitative Momentum. It's a good book if anyone wants to read it. So in that, they did some back tests around this momentum strategy on the US markets. So what they did was basically they have a typical strategy, like they take top 1,500 liquid stocks from the US universe, and in those stocks they basically try to understand uh, which stocks were performing. So for example, they take top 100 stocks which have highest returns in the last year. So they do a little bit different. They skip the latest month, but for simplicity, we'll take it as in the last year, which are the top 100 stocks which have given the highest form of returns, absolute highest returns. So they take those 100 stocks, and then and then they calculate the quality of those stocks as well. So how do you calculate quality in a momentum system? So basically, they see how many of those stocks had the highest number of positive days. So if a stock has higher number of positive days, then it means that the stock is going up little bit slowly in a proper linear manner rather than a very big up spike or a very down spike. So when you have a higher number of positive days, it means that the momentum quality is better than a stock which was not going up for 7 months but just went up for 3 months. So to find those very good quality momentum stocks, they try to filter out stocks which had more number of positive days, and they take top 50 stocks from those 100 stocks with that momentum qualities from the momentum quality store. So just to refresh, they first take 1,500 stocks, and then they take the top 100 stocks which had highest returns, and then they use the momentum quality score to find the top 50 stocks. And what they do is they buy this top 50 stocks and just go long on them. There is no like short or anything. They just buy all these 50 stocks. Then they rebalance it every 3 months. So I'm not going to go into technicality of which month and etc. But they basically rebalance it every 3 months. And again, the same process is repeated. They rebalance it 3 months and continue this. Now, what they did was they backtested this from I think 1926 or 27, something like that. They backtested this strategy from then to 2013 in their book, and it showed that this strategy gave upwards of 18% returns, which is CAGR, and S&P 500 in the same time gave around 11% or something, 9 or 11%, something like that of returns. So it was a very big amount of uh, alpha that they could generate with this strategy. Now again, when I say this that the strategy generated alpha, it was a point to point back test here first, which generated alpha. It doesn't necessarily mean that momentum systems beat market each and every year or each and every month. No, that's not the case here. Momentum will underperform markets for decent amount of time, but over a long period of time, they also calculated rolling alpha. So when I say rolling alpha, what does that mean? So for example, if I start a system on 1st January 1930, so they will first calculate CAGR from then they will also calculate CAGR from 2nd January 1930, then 3rd January 1930. So this way, they get to know, okay, if I start this system on any damn day, do I still preserve that alpha? So for this rolling alpha, it comes out to be a range. So they calculated likewise 3-year rolling alpha, 5-year rolling alpha, and 10-year rolling alpha. Like if they start on a certain date, they took every date from 1930 and they started calculating returns for the next 10 years, 5 years, and 3 years. That's what it is called as 3-year alpha, 5-year alpha, and 10-year rolling alpha. And they calculated those alphas as well. And for most of the time, not every time, but for most of the 10-year rolling alphas, the system definitely beat the S&P 500. On the 3-year and 5-year alpha, not every time, but for majority of the times, the system did beat S&P 500. So that's how a typical that's what the research goes behind in a momentum system, and they have proven that it works basically. Now we can obviously talk about how it works in Indian markets. Are there any back tests in Indian markets and all that stuff? But let's see if you have anything else to ask here first.
So, Viraj, let's also talk about the papers by Rajan Raji and even Anish Teli wrote about it, and we can also discuss within Indian context. So that would be really helpful.
Yeah, sure. So Rajan Raju and Anish Taili, they wrote a very good paper. The paper's name is Long Factors, Not Short Change. So they did write this paper in which they did a back test over different factors. So they did back test over momentum, low volatility, beta, high beta stocks, low beta stocks, quality stocks. So these are different factors that they did backtest, and it's a very good paper if someone wants to go and understand how various factors performed in Indian markets. Now, the first thing that I want to say is like this paper is very exhaustive. It clearly defines what rules they used and everything. Now, before I go into this paper, I just want to highlight that for momentum, they did two types of back tests. So one back test was very simple and straightforward, which was like take last 12 months return and rank stocks accordingly and do the back test. And another was momentum wall back test, wherein what they did was they adjusted the momentum with volatility. So it's same as what NSE does with the CNX 200 momentum index. So they basically use the same formula. And before I tell you the results, I also want to tell how they did the backtest, which is very important. So typically today, if I want to do a backtest, what a usual person might do is they will just download the current Nifty 500 constituent, say from NSE website, and they will run the backtest from 2008 on those stocks. But there is a very big flaw in this kind of a backtest, which is survivorship bias, because the stocks that are today in the index might not be there in the same index during 2013 or 2015 or even when you're starting the backtest. So that brings a big survivorship bias into the backtest, and it can really bloat the results, because the stocks that are present today in the index are mostly the winners that survived, and the losers that might have been delisted or taken out of the index will never appear. So it is very important to adjust this whole index data for survivorship bias. And this paper actually does that. They didn't only take the stocks which are present in today's index, but they back calculated and took every stock that was present in CNX 200 index from 2000. I don't exactly remember right now from when they started. I think it was 2007 or 2008 from when they did the back test. And they basically adjusted the data for every rebalance at that point in time. The rules were very simple. So we'll discuss about the momentum wall backtest, wherein what they did was they calculated the last 12 month and 6 month returns, and they adjusted it for volatility uh, and calculated a Z score, which is like a momentum score. I'm not going to go into details of the formula much right now, but basically a volatility adjusted momentum is what they did. Uh, it was on BSE. It was on 200, top 200 stocks which they used. The portfolio was equal weight, and there were 20 stocks which they kept in the portfolio. So 200 top 200 stocks in which 20 stock portfolio was there. They rebalanced it every month, and basically they did this back test. Now again, it was not just a point to point back test, but they also gave us the data for 3 and 5 year rolling alpha as well. So for example, if I take this volatility adjusted momentum, the mean, as in the mean 3 year alpha. I'm not saying the returns. This is alpha. Alpha is basically returns higher than the corresponding index. So if BAC gave 10, BAC 200 gave 10% returns and momentum strategy gave 20% returns, then it's kind of a 10% alpha there. So they calculated this mean alpha over every 3 and 5 year period. So that's why it is called as 3 year rolling alpha and 5 year rolling alpha. So the mean 3 year rolling alpha for this volatility adjusted momentum was 9.4%. Again, this is alpha, not the returns. Okay. And the mean 5 year rolling alpha for the same strategy was 10.3%. This backtest is from 2007 to 2022 or 2021. I again don't remember the last date until when the results were there. So it was great. So now we might think like, okay, this is alpha, but what about transaction cost? As we rebalance every month, there are transaction costs, right? There is brokerage that we need to pay. There are exchange transaction charges. There is tax that we might need to pay, and all those things. So they didn't only just do a basic back test. They also incorporated costs in that, and they did very rigorous analysis, and it was really good. Uh, so after adjusting for costs, what they did was they again run the same strategy, and when they adjusted it for cost, what they found out was the alpha still remains. It's not as much as what we just listened to, but it was still there. So for example, again, if we adjust for costs, uh, the alpha, again the 3 year alpha after costs was around 5.6%. So that's still a decent bit of alpha even after adjusting for cost. And they took proper like brokerage cost with in percentage the impact cost, that is the slippage that we give. So for example, if you there is always going to be a slippage when you buy and sell a stock. So adjusting for that slippage, adjusting for brokerage, and then calculating the cost, and basically recalculating the whole strategy. So even after adjusting for costs, the strategy still gave like 5.6% of alpha, 3 and 5 year rolling alpha. Again, the amount, the percentage that they used was technically a little bit higher. Conservatively, when you actually do this rebalancing and everything else, the costs are a little lesser. I have seen that in my own strategy as well, where I run it live. So the costs are definitely lower than what they have considered, but it's good to know that even after doing such kind of cost calculation, the alpha still remains. Hmm. So this is what the paper was about. And so yeah, so yes, Prince, anything else that you want to know?
So, Viraj, let's talk about ranking the stocks and how to choose stocks in the sense like how many to select. Although the backtest you told like they were equal weight and 20 in numbers. So, how your strategy, your personal strategy goes in that sense?
Yeah, sure. Uh, so the ranking is something that is I will come to my system as well in a bit, but first to like talk about ranking and rebalancing and all those things. So ranking of stocks can happen in multiple ways. Uh, so the very basic system, the very basic way of ranking is just first you have to select what kind of index do you want to use. So for example, there are multiple indexes, right? So we have NSE 50, Nifty 50 index, Nifty 100, Nifty 200, Nifty 500, Nifty all total market, which is the top 750 stocks on NSE. So basically, there are different types of index. So first, you have to understand like what kind of universe of stocks do you want to select from. So typically, it's good to consider all stocks like all the stocks listed on NSE, or you can at least select the Nifty 750 index, which is the total market cap index provided by NSE. And once you finalize your index, what you have to do is you have to rank the stocks. Now, there are multiple ways to rank the stock. The first and foremost, the very simple way is to just take simple price returns, absolute price returns. For example, if today is 31st May, so you will calculate returns from 1st June to 31st May in percentage for all the stocks. That is the first step. And the second step is to rank them in descending order. So basically, the stock that gave the highest returns will have a rank of 1, and the stock that gave the lowest returns will have the last rank. So this is how you can rank the stocks. This is a very simple ranking methodology, and you can buy the top stocks. So for example, if you want to buy top 20 stocks, then you take the top 20 ranks and basically divide your money equally and buy them off. The second way is volatility adjusted or sharp based ranking. What you do it in that, what you do in there is basically you penalize the stock returns with volatility. So every stock has a volatility, right? So for example, if a stock has a volatility of 30%, then you divide the return by that volatility. So for example, let's take an example of say ITC. For example, if ITC gave 100% returns in the last 1 year, but its volatility was say 50%. So you divide your return by 100 by 50. So that gives you 2%. So that's what the volatility adjusted return is, or sharp return. And if suppose Reliance also give 100%, but the volatility that Reliance had was suppose 80%. And now these are very random numbers. No, volatility never, very rarely goes to 80%. But so you divide 100 by 80, and that comes to about 1.2 or something. So with this ranking, ITC will come on top because it had 2% volatility adjusted returns, while Reliance had 1.2% volatility adjusted returns. So ITC will be ranked as 1, and Reliance will be ranked as 2. So this is another way of ranking. You rank the same stock, you rank the stocks from the same index with sharp returns, and basically go long on the top decile of the stock. So it can be top 20 stocks, top 30 stocks, top 10 stocks. It's up to you, like how much risk you want to take and all those things. But this is one way of ranking. And You can also include other parameters like number of positive days, or the listing history and all those things as well. So it can go into a lot more detail. But these two, I would say, are the basic simple. You can also include, say, volume. Like if you don't want to go into penny stocks or low liquid stocks, you can also include discard stock which have low volume. So I basically discard any stocks which has less than 1 crore of volume, a median volume. So in the last year, I calculate volume for every day for every stock, and I check the median volumes. And if the median volume is less than 1 crore, I will not include that stock in the ranking methodology. Likewise, depending on your capital, you can increase or decrease a little bit of your volume filter as well. So that's there. Then you can also include number of positive days. So for example, some people don't rank stocks which have less than, say, 40% positive days. So that is also valid ranking filter that you can include. So there are plenty of these ranking filters. You can decide what you want to use and what makes comfortable for you. So this is how you can rank the stocks. That is the first step. The second step is you have to decide your rebalance period. So once you buy these stocks the first time, you need the ranks again, right? Because some of these stocks will fall in the ranks, so you have to also check the ranks. Now that can happen either every week, every month, every quarter. Again, it's up to you. There have been relevant research that 1 month works nicely, but 1 week is also not a bad time to rebalance. So during this rebalance, again, you can rebalance in two ways. One is you again redo the method that we just did, like rank the stocks depending on your methodology and take the top stocks. So whatever stocks are common in the list, you keep them, and whatever are not there in the list, you basically sell those stocks and buy the new ones that have entered the list. A very basic rebalance methodology. Other methodology to rebalance is you can basically skip the stocks. You can basically keep a worst rank held. So what that means is basically, suppose the stock that we bought in the last rebalance is not in top 20 ranks today, but is in top 30 ranks, then you will still keep the stock. So you are not selling the stock just because it fell by 5 ranks. You will have like a worst rank. Like I will only sell the stock if it goes beyond 30 ranks, because sometimes stock can go a little bit up and down and all those things, right? So that's why you can wait until the stock falls below 30 rank and only sell it when it goes beyond 30 ranks. So that is another way to rebalance basically. um, and yeah, so this is how you can basically, these are two ways, like buying a set of stocks by ranking them first and then rebalancing this. You have to do this method every week and every month and stuff like that. Again, like it it's very simple to listen to this, but very tough to follow, because when you see your stocks are getting sold or they are still negative and you're still buying them and stuff like that, it's very difficult to stick to that process. Again, momentum does reward us, but sticking to it is also very important, because it's not easy to stick to it. Momentum is not a holy grail system or something like that. It has its set of drawdowns. So during 2000, after the 2008 crash, it took quite a bit of time for momentum to recover. So in my backtest, what I saw was between 2009 to 2014, momentum was still under drawdown. What I mean is the high that it reached in 2008, it couldn't breach that all-time high until 2014. So for 5 or 6 years, momentum was still under drawdown, uh, even though the markets recovered. So these kind of things do happen with momentum, and you have to be ready for that. Like you cannot just say like this is a holy grail and this will work all the time. So even though you follow the whole process, there is a very high chance that it can give you large drawdowns, and you have to be ready to bear that basically. But it does reward you in the long term, is what I've seen. Uh, so yeah, that's how we can rebalance and rank the stocks, Prince.
Right, Viraj. So how, I mean, when we talk about back tests, right? So how reliable those can be? I mean, can we totally rely on that, or like how it goes? And also, let's talk about historical drawdowns in the strategy. One you already talked about. Maybe another data you want to share.
Sure. So, to be very honest, right now there is no platform available, direct platform where you can just like put in some numbers and you can backtest momentum strategy. Because the first and foremost thing is the survivorship bias adjusted data is just not available. You have to build that data. It, like, even though you get an Excel, you have to import it and properly build it up. There is no ready-made platform right now available where you can do the backtest. The backtest, most of the backtest that you see on popular, I don't want to take the names, but most of the backtest that you see on the internet with Twitter and popular platforms are not survivorship bias adjusted. There are a couple of them, not all of them, but most of them are not survivorship bias adjusted. So the returns are pretty much inflated, and those are not the true returns. Like, it's very tough. Like, they show like 35-40% returns, and that's not realistic. You shouldn't expect something like a holy grail system here. That's not the thing. For backtesting, if you want to backtest it yourself, you have to learn to use probably AmiBroker or some other backtesting software. Or if you are a programmer or software engineer, you can use Python or any other language to backtest. But if you are mostly a non-coder, then AmiBroker is the most easiest platform. It's much easier to store data there, the survivorship bias adjusted data, and do a backtest. So AmiBroker is the only software right now that I can suggest in terms of a non-coder. But you have to learn it again. It's not easy. You cannot just go and do it in a few minutes. You have to learn AmiBroker. You have to understand how to get the data stored there with survivorship bias year wise and all those things, and then you have to also learn to write AmiBroker coding language, which is AFL, and basically then you can do the backtest. For the backtest that I was talking about, so basically historically the drawdown what I have seen is around at least 45 to 50% during the, but it was during the 2008 crash. So that was like when markets went down 60%. It's not like it was a regular occurrence, but it was a big drawdown that happened during 2008 crash. It could have been a little bit optimized. People have come up with rules to get out of such kind of drawdowns, but we don't know how it will work in the future. But there are solutions to that, depending on the volumes and what kind of how the actual index is performing. If it is below 200 moving average, then you can probably uh, get out of the stocks and stuff like that. So there are ways to get out of the stocks to save us from such a huge drawdown, but it comes at the cost of returns as well. The returns will go down a bit as well with that. What I've seen is like in 2008, it was 50% drawdown. During COVID, I have seen systems with 25 to 30% drawdowns as well, but they recovered very soon before the market, even before the market, I would say, most of them. And the historical drawdowns in the US, the quantitative momentum that I thought that I talked about a little bit earlier, there the historical drawdowns have been near to 75 to 80%. But that was during the 1929 crash that happened, the big crash that happened during 1929, the Great Depression that happened in the US. So again, during the, but it did happen. The crash gave around 75% drawdown. Uh, what I think is most of this system, like quantitative momentum and other systems, the backtests that they have done are mostly in context of never going to cash. So they never go to cash, even if there are negative returns, they still buy the top decile stocks. But in our own DIY momentum systems, if we can go to cash, like for example, if there are no stocks with positive returns in the last year or last 6 months, we can decide to go to cash and not even buy any stock. So with those modifications, I do think we can reduce the drawdowns a bit, and if we include some other filters, but it wouldn't reduce it by a huge chunk. It will still, the drawdown will still be there around 25-30% at least, but not like 50-60%. That's what I think. Again, I can be wrong in the future, but this is what I at least think.
So Viraj, like when say some strategy is new, then there are high chances of creating good alpha. But as soon as it becomes like talk of the town, so do you think if that happens, the mojo of creating alpha goes down, and on the top of that, like how you expect things to go in future?
Yeah, I mean, what you say, I would say it is technically correct, but so momentum systems do have a size restriction, but it's not as low as we think. Like, just because thousands of people are doing it doesn't mean that the momentum system has gone out of favor or it will stop working. That's not the case. See, momentum. Why first for that we need to understand why does momentum work, right? So just because something is going up and we buy it, why does this produce alpha? So the main reason before that is the that I actually think, and the papers, the research papers that have been published say that it is because of underreaction to positive news. So what does this mean? So for example, if there is a stock A and suppose the stock price was 100, it went up to 130 now in the last 6 months, and it starts, and people start noticing it, like it gave 30-40% returns say in the last 6 months. Now people say, अरे यार ये तो मैं 100 पे ले लेता तो I would have gone got already 30% रिटर्न्स, अब लेके क्या करूँ, मतलब ये तो अब किधर ही ऊपर जाएगा, और एक साल में 30% से ऊपर किधर कुछ जाता है. So this is the underreaction part that I'm talking about. The stock is probably not just going up because just with volumes, but it might also be going because uh, the business is doing good. There are some tailwinds to the business which will give more profit to the company, which normal public might not know. So this underreaction to positive news is what happens, and then what happens is people start disbelieving the story first, like okay अरे ये तो इतना आ गया, अभी और कितना ऊपर जाएगा, then it goes from 130 to 150, then people say हाँ अभी तो इसका टॉप हो गया है, then it goes from 150 to 180, then people start अरे नहीं ये अभी जा रहा है ऊपर, मतलब then people start piling up into 150s level. फिर वो 150 से 200 जाता है, फिर एक यूफोरिया फॉर्म होता है, 200 से 250 300 तक जाता है, एंड वंस इट लाइक ब्लोज ऑफ द स्टीम इट माइट गो फ्रॉम से 300 टू 350, फिर 350 से वापस 300 तक आएगा, 300 से वापस 250 200 तक आ सकता है. So this is how a typical stock journey might happen with underreaction and overreaction to news. Now what a momentum system will do is it will take out all the discretionary part कि बाबा ये ऊपर गया तो क्यों buy करने का, इतना भी हो गया करके ऐसा सब. So it will not react to that. What it will do is it will simply follow rules. So momentum system might come in at the stock at 150, मतलब वो 50% up होने के बाद शायद momentum system उसमें entry लेगा, but it will not be able to exit at the high of 350 as well. Once it starts underperforming से 350 से 300 280 तक आ जाएगा, तो momentum system will probably exit it at 280 250 some at those levels. So this 150 to 250 का जो move है वो momentum system आपको दे देता है, but it is very rule based, so आप entry भी कर लेते हो और exit भी कर लेते हो properly. So that's how this moment, that's why I think momentum investing works. In a discretionary system what will happen is you might buy it at 150 200 probably, एंड आफ्टर दैट वो 200 300 350 तक जाएगा, एंड वापस 250 200 तक आएगा तो भी आप बेचोगे नहीं, यू विल थिंक दैट नहीं है वापस ऊपर जाएगा, ऊपर गया था ये 350 वापस लेगा, एंड यू विल वेरी रेयरली सेल इट, या एकदम लॉस पे सेल करोगे या कॉस्ट टू कॉस्ट पे सेल करोगे. तो दैट्स वेयर यू लूज ऑल योर गेन्स. बट मोमेंटम सिस्टम इज अवॉइड ऑफ ऑल दिस इमोशंस की बाबा नहीं, दिस इज वेयर आई विल बाय, दिस इज वेयर आई विल सेल. So this is how typically I think the underreaction to positive news is why momentum system works. And to your point, ki, if everyone starts following it, will it stop working? I personally don't think so. There is definitely a size restriction which I think is very high. I don't think it is like ki 100 200 crore aa jayenge to it will stop working. That's not it. The depth of Indian market is definitely bigger than 100 or 200 crores. And this underreaction to news and everything will happen at very large level. मतलब it's not easy to stop that system from working very easily. And the second part is very rarely do people follow the rules. मतलब कोई सिर्फ बोल रहा है मोमेंटम सिस्टम फॉलो कर रहे हैं इन्वेस्ट, doesn't mean that they're actually doing those all entries and exits properly with discipline. Like doing this with discipline is very tough. There are few like ये अपना CNX 200 का मोमेंटम म्यूचुअल फंड इज वर्किंग फाइन. देयर आर फ्यू PMS लाइक CM का PMS है, which capital mind ka PMS hai, which does have pretty decent amount of AUM on the momentum system. Then there is all the small cases which are working on, which are putting a ton of money on momentum system. At least there is at least around 10 to 20,000 crore minimum on riding on momentum right now. uh, if not rules weight, if not very much into rules weight, but at least in that form of structure with constant rebalancing. And I don't think the system is out of favor yet. And in future also I don't think it will be out of favor, because people generally let go of system, ये rule based system जो रहते हैं, people generally let go of them at the worst times and come back in at the best of the best times. So that's not how it works. You have to write through all the positives as well as the negatives to actually get uh, the reward of that system. So I don't think in future ये system काम करना बंद होगा. It will work very nicely. And the research has also shown कि US में and even in other emerging markets, this system has been working for the last say 70-80 years जिधर research है इतना. I mean the paper came out in 95 2000 around that. Even after that 25 years the proper rules based momentum system is still working in the US. Even in the emerging markets there are many other papers which have come for different emerging markets like Europe वगैरह. And if you want to just see how momentum system perform for different markets, just take say ms google इतना ही टाइप करो MSCI, फिर कंट्री का नाम फॉर एग्जांपल जर्मनी, MSCI जर्मनी मोमेंटम इंडेक्स, ये चार वर्ड्स टाइप करो, आपको एक लिंक आ जाएगा. उस पर टॉप दो तीन लिंक में एक PDF का लिंक है. When you click on that, you will see different momentum system के results. MSCI runs momentum systems from different countries. It is not available for every country, बट मोस्ट ऑफ द कंट्रीज आर देयर, जैसे कि ऑस्ट्रेलिया, यूके, जर्मनी है, फ्रांस है, देर इज अ होल वन फॉर यूरोप, कनाडा, इंडिया का भी है उसमें. Now you can just search and you will see like for various countries this does work, and they have shown year wise returns, alpha and everything there basically.
Right. So, I mean, going by your experience, so what would be your suggestion if somebody wants to create their own strategy? What rules to follow? How to go about it? I mean, although we discussed it pretty well, but again, what would be your suggestion if we ask it precisely?
Yeah, sure. So so for so सबसे पहले तो is very the most important part is the index that you want to choose. So one can go for all the stocks, or second you can basically decide one index. Now it all depends on what kind of volatility you are comfortable with. मतलब जितना ज़्यादा small cap mid cap में you will go, you will have tad bit higher volatility there because they move a lot. The small cap and mid caps are much more volatile than large caps, but the alpha is also present there because the information asymmetry is there in small cap and mid cap. What I mean is, in large cap most of the companies are covered by a lot of analysts. All the information that has to come is mostly available outside, so there is no information asymmetry. If there is some good information, people mostly know about it, these analysts, and there is already some buying there. So udhar getting that big alpha is still a little bit difficult. Alpha milega, but it will be on a very smaller note. When you go into small caps and mid caps, that's where the actual information asymmetry is present. It is not asymmetric information. There is still insider trading. There is still a lot of news that comes out late, and the price behaves much earlier. You can see in lot many stocks like RVNL में जैसे अभी हुआ, the order news came later, but the stock actually zoomed up before the order news even came into the mainstream media. So likewise, there are a lot of things like this which happen in small cap and mid caps. So for me personally, I use the Nifty 750, which is the Nifty total market cap index, but you can also use say Nifty 500 or use all the stocks. If you're not comfortable with volatility, I would say stick to Nifty 100 or Nifty 200 because with large and small mid caps, as I said, the volatility will increase. The second is the ranking methodology that you need to use. So I personally use sharp based ranking methodology, wherein I rank stocks adjusted for their volatility. And the third thing that you need to decide is how many stocks to select. Now there is various research. Some research says that even top 15, like around 15 to 20 number of stocks are also enough, or 50 stocks are also good for diversification. I personally go with 30 stocks, not because some research has told me to, just because I feel comfortable. Because with 30 stocks, the most exposure I will have to any stock, I will have to any of the stock is 3.33%, and that's a good enough exposure कि भाई कल stock अगर overnight 20-30% gap down हो गया तो I don't have to worry about big effect on my portfolio. So that's why I try to keep it at around 30 stocks. Again, it's a personal choice. You all can go with 15-20 stocks as well if you are comfortable. I wouldn't say go with 10 stocks. Keep at least 15 stocks. 20 stocks is better, but even 15-20 stocks works wonders. I personally keep it at 30 stocks. My rebalance happens monthly. I rebalance it every month, but I'm open to rebalancing it weekly when there are high volatile periods. So if the volatility shoots up a lot, I will switch to weekly rebalancing until the time the volatility remains high. But otherwise, I will be at only monthly rebalancing. And yeah, I mean, I this is what I do. I keep 30 stocks, and I keep the worst rank held parameter as 50. So I will not sell a stock unless and until it goes beyond the 50th rank, basically. And I will post a link after this. What you say? Uh, space is over. But if you can go to that momoindiascreener.in website, there is already a public screen called as Virat's momentum screen. You can see all my rules there. That's the screen that I use for my momentum system. It's not like hidden or something. You can just check that link. You can just go to that link, and there are four boxes on the website on the homepage itself. There is one box called as Virat's momentum screen, and you can click on that. You can see all the filters that I use basically.
So, I mean, one screen you already told about. So, is there any other sites where we can look for such screens, and which broker to use? How to decide on that? What charges should we expect? So, let's also talk about it.
Yeah, sure. So the first thing is obviously my I'm shamelessly saying like my website is there, but second option there are few websites. So one can be Ticker Tape. That's a good one. You can use that for ranking stocks. The third is you can basically do it on Google Sheets. Google Sheets have last 1 year data, so you can just like one column can be the name, the symbol for the stocks, and one column can be the price 1 year back, one the third column is price today, and then you can basically calculate the returns with some Google Sheet formula, and that's basically one of the easiest ways. Other way is to use Yahoo Finance. Like you can create watch list on Yahoo Finance. You can type in the name of all the stocks, and then they have different columns like 1 year return, etc., and you can sort on them. One other option is if you are a little bit tech savvy, you can use Ami Broker or some kind of a functional coding that you might do yourself using Python, and then you can create your own ranking system, customized ranking system as well. So these are a few things which you can use. Other than that, I think for brokers, I would say please stick to no brokerage brokers. Like say, I personally use Zerodha, but you can use any zero brokerage broker like Fire, Zerodha, Upstocks, or anyone. Please don't go with a full service broker. The problem is the brokerage there is 0.25 to 0.5%, which eats up a lot of your returns, because the rebalancing here is so much. You rebalance almost every week or every month, and there is at least like 20% turnover at least in every rebalance. So in that case, please don't use a full service broker. It will eat up a lot into your costs. Use these brokers which have zero brokerage charges. The other charges are pretty much similar, like STT, exchange transaction charges, and all those things will remain same across all the brokers. So those are to be expected. But if you use a free delivery, like no delivery brokerage broker, it will be a lot more helpful for you. It will at least not eat up into your returns. But typically, my observation is that whatever charges you get, like STT, exchange transaction charges, etc., those are pretty much covered by the dividends that you will receive in a momentum return. So because you own stocks, you will definitely have some dividends which are being declared by the companies, and in that case, these returns, the dividends that you get from these stocks are pretty much enough to cover your charges, at least in my observation.
So, Viraj, like, is there any, I mean, ticket size which you suggest or you had experience to start with? Like, is there any minimum ticket size one can, or even with small capital, people can start doing this thing?
I think you can start with small capital as well, but at least like keep. So if you're doing a 20 stock momentum portfolio, I mean, you can do it with 50,000, but I would say at least start with, say, a couple of lakhs if you can. It's okay to start with 50,000, but like dividing 50,000 into 20 stocks is like 2,500 per stock, right? So, like, you don't really, you have a very limited amount of stocks that you can buy. You say you have if a stock with the stock price of 5,000 comes in your ranking system, you cannot buy it because you can only buy 2,500 rupees per stock. So it's better to at least have a lakh, 1 lakh, minimum 1 lakh. I'm still giving a very low capital. I would say I would personally prefer like at least a couple of lakhs. But if you want to do it anyway, please at least start with like a 1 lakh capital minimum, if not more. yeah, I mean, don't start it with say 10,000, 20,000, or 50,000 kind of capital.
Right, fair enough. So, any view on reading materials, and please name the papers once again, because one of our attendees was asking in the comments the ones which you already explained, the papers, right?
Sure. Yeah. So for reading, you asked reading material, right?
Right,
Sorry.
right, right.
Yeah, so reading material, I would say two books are very nice, very properly explained. One is Quantitative Momentum by Wes Gray. I will tweet after this piece everything, the paper names as well as the links as well. So Quantitative Momentum by Wes Gray, and another is Stocks on the Move by Klinau. These are two good books. They are basically on momentum. Stocks on the Move is basically also momentum system book. Those both of them are very good books. They tell you why momentum works. They also tell you the exact strategy that they have used in the US, along with the backtest returns, per year wise backtest returns they have given. So those two are very good books to go in depth. And stocks on, I would say start first with stocks on the move, because it is much easier to read, has much more data, and you can pretty much finish it off in say a week or two at the most. For the papers, as I said, a lot of papers, but for Indian context, I would say please read the paper Long Factors, Not Short Change by Anish Teli and Rajan Raju. It's a very good paper.
Great. And for our attendees, so just in case you have questions, please send in a request or maybe simply type in the comments. And also, like the wonderful insight shared by Viraj, we can surely connect with his handle so that we can. Viraj, you can also tag me with the books and the material so that I can also share within my circle. So let me check if we have any questions in the comments. So okay, yeah, one was okay. Right. We already covered these questions. So, Viraz, anything which you had in mind and I didn't ask, maybe, so anything which you want to cover, ORB or maybe something, anything to your
Yeah,
mind?
so one thing I just, as a caveat, I want to say, like, don't put all your net worth in momentum systems. Like, maybe if you're confident enough, please, yeah, put your equity component of your asset allocation into momentum. But please don't put all of your net worth in here, because it has big drawdowns and it's just not easy to handle those drawdowns. So, and please keep asset allocation. Don't go 100% into equity ever. Keep your asset allocation always. Keep like whatever is better for you from your age perspective, like keep your asset allocation, and maybe start with say 20-30% of your equity allocation to momentum systems, and then eventually increase it out as you gain confidence and are committed to the system. Because it is very much important to be disciplined on this, because if you're not disciplined and you basically don't follow the system rules properly, then you are not going to get the reward. Like, it is plain and simple. So yeah, that's pretty much it. Keep your asset allocation and start small and eventually increase it.
Yeah, I totally agree with this advice. Asset allocation is very important in investing. So, Viraz, I mean, the questions which I had in my mind, I already asked you, and you very, uh, I mean, you explained it brilliantly, and it surely opened a thought for our attendees so that they can take today's discussion as a starting point, and slowly and gradually they can learn the nuances of momentum investing. And I also thank Manish Dhawan for introducing Viraj to me so that we set up this session today. And guys, this session is recorded, and those who joined late can surely revisit the recording, which I'll be placing over my YouTube channel. So thank you so much for taking out time, Viraj, and it is great to have you. Any concluding remarks before we close?
Nothing per se, but yeah, it was great to talk about momentum here. Thanks, Prince, for again for inviting me. And I, yeah, I really like momentum systems. It's very rule based, and I hope you all got some insights into this and want to have some part of your allocation into it.
Great, many thanks. And for our attendees, just in case you have any questions in future as well, so surely you can and ask Viraj over DM, or maybe you can tag him and me, so that we try to take your question. But again, do not ask for any stock specific thing, right? So process we can always discuss. So Viraj, I would request the research papers and the books, the content which we discussed, right? So if you can pen down one tweet and maybe share with the attendees, that would be really helpful. And guys, if you're liking our spaces, do connect with us, and especially with our guests who take out their time and share their strategies, so that you can also learn from that and imbibe those good things in your process. So with this, I take your leave. Thank you so much, everyone, for joining, and surely and will be coming with another guest on some other topic of interest to everyone. And keep supporting. And if you are yet to subscribe to my YouTube channel, please do that, because it takes a lot of effort to um, coordinate and do such nice sessions. So you can also reciprocate by showing your love. Thank you so much. Good night. Take care.